Awesome. So we'll get started now. I'm Carla Policastro, joined by Joe Policastro. Uh, we're both co-founders of Cycle CPA. We're doing anything from bookkeeping to CFO services, and we're just specializing within the green industry. So super excited to, talk with you all today about the balance sheet. I feel it's like one of the financial statements that business owners really don't want to get into, but we'll try to keep it exciting. It's an important financial statement, so super excited to dive in deeper.
Yeah, thank you for joining us tonight, everyone. So what do all of these have in common, right? So you got equipment loans, asset purchase, distributions to the owner, unearned income, cash property contribution from the owner, mortgage loan. One thing that they all have in common is they're not in the profit and loss, right? These are items that influence your business, and they're actually in the balance sheet, right? So This is why it's important to really have a well-rounded knowledge when it comes to knowing all of your financial statements, not just your profit and loss statement, which is what we see. A lot of people have a general idea with. So that's why we're gonna take a deep dive today.
Yeah, and before we go any further, I do have a poll for you all to take. I'll publish that now, and it's how often do you review your balance sheet? Let's see. I'll give you guys a minute or so to answer this, but I'm interested to see, because again, it's one of those dreaded statements where I think it's because it's not easy to interpret, right, Joe? It's not as straightforward as the profit and loss, where it's just like sales and expenses, easy, right? And then whatever's left over, that's your profit or your loss. It has a lot of accounting mumbo jumbo, but yeah. So, but it has a lot of valuable information. So let's see here.
Awesome.
I'll give it a couple more seconds, and then we'll close it up soon.
Yeah, and the balance sheet, it reports three main things, right? So it's talking about assets, liabilities, and equity at a specific point in time. So it's not for a period, right? You're literally looking at a specific point. So as of let's say March, or March 31st of 2022. It's more of a snapshot, and it's really what a company owns and what a company owes. Also looking at the amount invested by the shareholders as well, and it has to be balanced. And what do I mean by that? Assets have to equal liabilities plus your equity, which is shown in the diagram here as well.
Yep. And like Joe said, it's a snapshot in time. So the balances are cumulative, they add up on top of each other. So it's not like the profit and loss where you pull it up for that time period. All right. So I'm going to end the poll. All right. So most of you said, well, this is surprising, but a good surprise. Most of you said weekly at 28%. And then we have 20% said never. So, all right.
We're going to change that here.
Yeah, for sure.
And then, so here on the diagram, has some of the financial statements, and, focusing on the balance sheet. As we mentioned, you're more, looking at a specific point in time, looking at the specific financial position, right? The health of the business right now. That's what the balance sheet shows you. Looking at your assets, liabilities, equity, where the starting point is actually your cash balance, and your ending point is your retained earnings. So, Carla, can you dive into what retained earnings is?
Yeah, so retained earnings are the earnings that have been retained over a period from the business. So let's say that you have been in business for 2 years now. And so year one of business, if you made a profit of 10,000, then that converts over to, it gets closed out of your profit and loss for year one. And then at the end of year one, as of 12/31, it goes on your balance sheet as retained earnings. So you'll see 10,000 in retained earnings. And then let's say year two, you close your profit and loss at 5,000. And so that gets accumulated to your retained earnings. So your ending retained earnings at year two would be 15,000. And, the same goes if you had a loss. If you had a loss, then that retained earnings would decrease whatever you've had, or it would just go into a negative balance if this was the first year you started in business.
Awesome. And this is a general look at, it isn't very detailed, but this is, these are the main sections of the balance sheet. You know, and we're gonna go deeper into each category, but looking at the assets, what's made up within the assets, the current and the fixed assets, the liabilities and the equity. You have the current liabilities and long-term liabilities and the equity. And then as you can see, the total assets equaling your liabilities plus the equity, which is the 172,121.
Right.
And this is another look at, how all the financial statements relate back to the balance sheet. So for your profit and loss, your net profits, and that relating to your net profit within the balance sheet and the earnings that you have in the current year. Whereas your cash flow statement and the cash at the end of the period relating to that cash balance, as we went over before as well in the balance sheet. So this gives you an idea of how the statements what the relation is in between the three statements.
Right. Yeah. And it's important to know that the three main financial statements and how they're interrelated with each other, because if one financial statement is off, then the next is off. So if you don't have your profit and loss correct, then you can pretty much count that your balance sheet won't be correct, and therefore your cash flow statement wouldn't be correct. So
yeah, this is what makes accountants excited, when things balance out.
yes.
And there's a bunch of different reasons why you should have this data, this balance sheet, all the financial statements available, so you can make decisions based off of it for lenders, investors, vendors. But as for a lender perspective, how safe is it from their perspective? Is it to lend money to your business? How much are they potentially willing to give? Also based on that, what are the interest rates and terms? And they do want to see skin in the game, so the equity that you have in the business and assets that you have as well. So they take all of those items into account.
Yeah. Yep. Bankers want to see the balance sheet. They want to be able to review the balance sheet yearly if you do have a loan with them. So it's important that that's always up to date for that reason. And here we're going to take a deeper dive into just the asset section. So an asset is a resource with economic value that a business owns or controls with the expectation that it will provide a future benefit, right? So a current asset is expected to be converted to cash within 1 year. So that's your business bank accounts, cash accounts, your accounts receivable, inventory, and prepaid expenses. And then your non-current assets are not expected to be converted to cash within the year. So this is your equipment, so your skid steers, your trailers, your trucks, things of that nature, furniture, office equipment.
Fantastic. And then there's some main questions and potential problems that come with assets, right? That we come across a lot. And I guess to start, accuracy comes with also keeping your books updated, right? Do the assets that you have on the books, do they still actually have economic value to your business, right? Because some of them may be obsolete. You may not be using some of the equipment or vehicles and different things within your business. So potentially look to write those off. You don't want those fogging what the actual assets are within your business. Also, making sure that your inventory is entered in correctly and being tracked, and also coming up with asset and depreciation listing.
Yeah.
That's a huge thing.
It is. It is a big thing. An asset depreciation listing is you can have it. We usually keep it for our clients in an Excel sheet. It has the assets, so your skid steers, your mowers, your trailers, all listed there. The date in where you purchased it, the amount that you purchased it on, what type of asset is it a mower, a trailer, a truck, and then also the useful life of that asset. And so I'm kind of going to jump to the depreciation book versus tax. It's important to keep track of the useful life on your books based on book basis and not really tax basis. And the reason for that is because you want to recoup your expenses as closely as you can with what is happening within your business in actual time. So, for example, I could buy a vehicle for my landscaping business, and I know that I'm probably going to use that vehicle for another 3 years, right? And then I'm going to trade it in, or that is my plan, right? That's usually what I do with my vehicles. Let's say that this is you. But for tax purposes, your tax accountant, they want to write it off all in 1 year for a better tax savings for you, right? So if they post that all of that expense in 1 year for on your books, then your profit and loss is going to be distorted because that's not really how you're incurring the expense. I'm incurring the expense over 3 years. So you want to recoup those expenses in your estimate over the next 3 years. Because if you have tax depreciation for that vehicle all in 1 year, then the next 2 years, your profit and loss is going to look great. But guess what? I'm still using that truck for the next, for the 3 years. So what we do is with the depreciation listing is we set like policies on certain assets, and we work with the business owners to see, because every business is different. You may be someone who keeps your trucks for 5-6 years. You want to base it off of what you normally do or what you think you're going to do. And this is just a rough estimate, so it doesn't have to be exact. Things happen, right? So you can have policies, for example, like I said, trucks, I'm just going to expense that for the next 3 years. Or my mowers, I know I'm going to keep that for 5 years. So this is how I'm going to put it on my depreciation listing. So these are policies that you should have for your business, so that way you can post a depreciation every month and make sure that you're recouping that accurately within your estimates, because these investments that you're making with your skid steers, mowers, things of that nature, they're big expense items that you want to be able to recoup in a reasonable manner, right? So that's why it's important to know what book depreciation is versus tax and how that affects your profit and loss in your balance sheet. And the way that it affects your balance sheet is that on the balance sheet, depreciation is listed as accumulated depreciation, which is a negative item that is lowering your asset line item. And so if you're going to calculate ratios off of your balance sheet, then that's also going to be distorted if you're doing it on like a tax basis. All right.
Definitely, and that's, for instance, the asset newness ratio, which we're gonna go into later here. But
Yeah.
also, within the current assets, looking into accounts receivable, that's an enormous thing, right? For um, everyone's business, we want to make sure that you're um, getting paid on time, and knowing who is late with their payments, which is the aging report, right? What customers are current, 30 days late, 60 days late on payment, 90 days, right? Having a specific process for your staff on how to reach out, because the
Mhm.
customers are only going to pay as well as you invoice and follow up with that. So hold your team accountable with a specific process in regard to accounts receivable.
Yeah, and I just want to address this because so somebody just asked if we're looking at the questions. We're going to go through the questions in the chat at the end, so feel free to just enter in your questions as we go through. All right. Awesome. So here we have liabilities. So that's what the business owes. And so current liabilities are what you owe within 1 year. So your accounts payable, if you have a trade credit open with Site One, what you're going to pay them within the year. Deferred revenue. This is revenue that you've collected money on. So you've gotten a deposit for, but you haven't earned it yet. You have not performed the service yet. So if I got a deposit today for a pool install that I'm going to perform in July, then that deposit should be in deferred revenue, which is a current liability until I actually earn it. Then that revenue can hit my profit and loss statement there. Uh, Short-term debt like credit cards, payroll liabilities, and your current portion of your long-term debt. So let's say I have a payable with Sheffield that I'm going to pay over the next 5 years, but the current portion of that Sheffield loan would be the amount I owe this year only. Okay. Long-term liabilities are what I owe in more than 1 year. So again, that Sheffield loan that I would owe in 5 years, minus the current portion.
Awesome. And, just as with the assets, we see different things, as we work with some of the companies, and, looking at accounts payable, right? How much of that is overdue, and, as a percent, you don't want that to be increasing, right? Because that's a sign that, maybe you're struggling, maybe to have the cash available in order to meet that.
Mhm.
And then, the sales tax payable not being recorded. That's a big thing. But also remember that some liability is good for a business. See it as leverage, but also understand that it has to be weighed against some of the expenses, some of the business expenses, and it's why it's extremely important to make a profit, and ideally a high profit, so that you can not only, you know, recoup your expenses and your profit and loss, but then also cover your, especially your current liabilities, like as we mentioned earlier.
Yeah. All right, so the equity section. Business owners are always excited once we get to the equity section of the balance sheet and we're describing it to them, because we know that this is what the shareholder owns, right? So, and really what it's made up of is retained earnings, which we spoke about earlier, owner's draw or distribution. So this is money that the owner takes out of the company. Owner's contributions, what the business owner contributes, whether that's cash or property, and current year's net income. So things that increase your equity, right? This is what we should always be shooting for, is increasing that equity. So what is going to increase your equity is if you make contributions to your business, whether that's in cash or property, whether if you have accumulating net income, if you keep making profits, that's going to increase your equity section as well. And items that decrease your equity section, if you take an owner's draw, if you take money out of the company for your own personal use, or if you make a net loss, that decreases that. All right. And so there are common questions / problems that we see business owners have within the equity section. So some problems are like the owner's cash and property contributions are not being recorded. So what we see is that when we receive a set of books, it's sometimes the owners, when they open up a brand new business, they have had either trucks or machinery, equipment, small tools that they've had before they opened the business, but it didn't get recorded on the books when they opened it, because they contributed that property to the business, but it just never got recorded. So make sure that those items get recorded. And also, even if you're an established business, if you're contributing money to the business for whatever reason, just make sure that gets allocated to owner's contribution account. Another problem area that we see within the balance sheet in the equity section is if there are multiple owners, equity is not being allocated amongst the owners correctly. Owners that make personal expenses on the business card. And what happens is that then this decreases equity. Like I mentioned before, it's counted as a draw if you're making personal expenses on your business card. So you don't want to deplete your equity in that way. Events or transactions were not recorded prior to the financial statement end date. So, after 12/31, you realize that, you forgot to tell your accountant that you purchased a truck or something like that, and it didn't get recorded. Right now, you have to possibly amend your tax return and reissue those financial statements. Awesome. So this is a more detailed view of the balance sheet. And as you can see, it does say as of March 31st, 2022. So one of the things that I want to point out, because business owners are always pointing this out and kind of have questions about this, is the owner's draw section. Let me point it out. So here's the owner's draw. You see how that says negative 52,000? So sometimes business owners get a little worried about this number here because they say, "Oh, wait, 52,000. I didn't take that out of my account. Why does that say that?" And so it's a cumulative number. So this is maybe 52,000 that you've taken out of the business over a couple of years. It's not just that year. If you want to know what you just took out within that year, you would have to click into that and find the detail for just the year. And so another thing that I want to point out is the depreciation. Here it's negative because your assets are a positive number, but then as you expense this 72,000, then that gets decreased by the accumulated depreciation, which is negative here. Okay. Again, we went over why that's important, right? All right.
And one of the common things, should I use financing, right, or cash purchases when it comes to some of the major moves within your business? We did a past webinar, which is on our YouTube channel, Cycle CPA, where we go into the fixed assets and whether it's a landscape or snow business, and going through questions like this. So definitely, check that out. And there's positives and negatives to each. Um, Definitely not looking to over leverage your business. You don't want too many loans, and we're going to go into some ratios that are an indicator of that, and that you can go off of. Also, understand that when it comes to using um, financing, that means that your return on your investment will be higher, right? So it's ultimately weighing that return versus the risk as well. You can grow faster. Um, and you can potentially use that capital in other areas of your business that you can ultimately get a higher return on money. And just a couple other items here as well.
So the balance sheet, uh, it tells you the financial health of the business, right? So when you're looking at your balance sheet, it's important to compare it to the previous periods or the previous years to measure how well the company is doing financially. And it's also good to benchmark your balance sheet against industry averages. And those are the two major things that we go over during our meetings when we're looking at the balance sheet with our clients, because we want to know, is there improvement? What could we be lacking in, and so on. So how can the balance sheet help you if you're trying to make those important business decisions, such as maybe you're looking to purchase a new equipment or a vehicle, right? We have these four financial ratios here that will help you in making your decision. So the first one is called return on assets. So that's your profit over your assets. And this is showing how effectively you're using the assets that you have right now. So your trucks, your trailers, how effectively are you using those to generate a profit within your business? And as you can imagine, this is a big ratio for contractors because of the major investments that you have to make within your business. In order to get started within the business and even maintain the business long term. So, for this example, is this business that we're looking at right now, this balance sheet here, are they using their assets effectively to generate profit? And the answer is no, because their percentage is 8%. And the industry average is about 21%. So they're under that. So maybe
Yeah. And
just by looking at this ratio, they can determine that no, I need to find a more efficient way to use my assets that I have currently in place. But this is only half of the story. But yeah, what were you going to say, Joe?
yeah, and ultimately, you want to be better than industry average.
Yeah, of
That's
course.
the goal.
That's the
Because
benchmark. Yeah,
industry average are not attending these webinars, so we're gonna shoot for better than industry average.
for sure.
And this is a great ratio, return on assets. Why? Because it's holding your team accountable based on the net profit, right? Based off,
Right.
once all of your expenses um, are accounted for, right? So it shows the true efficiency of your operation. So
Right.
it's always great to whenever ratio is involved in net profit, it's nice.
Yeah, yeah, exactly. Because the bottom line is what matters within the business, right? Top line it looks all pretty, but bottom line is what matters. So, um, all right. So the next one you want to look at is asset turnover. That is your total sales over total assets. So what this measures is how effectively you're using assets to generate sales, that top line revenue. And so this business scored a 2.8. So they're right around the industry average. So they're doing well for generating sales. So this is a funny example here, Joe, because going off of what you just said, you want to hold your team accountable to net profit. So this business is doing good with generating sales with the assets that they have in place, right? But when it comes to net profit, not so good. So that's why it's important to look at both of those and kind of
Yeah,
diagnose that. It's
and
interesting.
just so everyone is seeing that, basically in the return on assets versus asset turnover,
Yeah,
really the main difference is looking at the numerator. So
right.
it's the net profit versus,
Sales,
in the asset turnover, then you're looking at the total sales.
right. Yeah. Um, Then we go into the debt ratio, which is total debt over total assets. Does your company have more debt than assets? If it did, you wouldn't want to go in and finance an asset at this time, right? So this business is at 0.81. So anything under one is good. So they're doing well. But again, they're only 0.19%, 0.19 away from being at one. So you don't want to be too, maybe you would have to look at the loan amount that you would need to go into that purchase of the asset, if you know. But I mean, they're almost reaching one here. So it's still okay, but I would like to see that number a little bit lower, right? Um, so asset newness, and you brought this up before, Joe. It's a really good indicator. It's really how new are your assets that you're purchasing? Are you purchasing often, or kind of you want to purchase all the new toys out there? Are you, or do you have outdated junk and now it's time to update your equipment and machinery to make your field laborers more efficient? And so this company is under the industry average. They're at 0.3. Industry average is around 0.5. So no, they're not really purchasing assets that often. So overall, I think that this business does have some availability to make a new asset purchase, whether that's an equipment or vehicle. But the most important thing is when you make this decision, looking at these four ratios to make an informed business decision, not based off of your gut or your checking account or what you think you need that day, right? So, and the next, after this, once you make your equipment purchase, you want to monitor these ratios after the fact too. So,
Yeah, and each business is different, and each business is better at different aspects. And you may find yourself below industry average on one particular, KPI, but better, So that's why it's tough sometimes when you look at, maybe a situation where, you know, you see a competitor always having up to date equipment, and um, you know it could be because they have cash flow coming in, and different things like that. It could also mean a totally different thing. It could mean that they're just um, mismanaging their capital, and so don't necessarily look at your competition in regard to that. Find out what you're best at, because you may find that you're better at optimizing in different parts of the business than some of your friends within the industry. So um, and just kind of understanding that, and understanding what you're good at.
yeah, yeah, that's a good point. So, let me see.
And this next slide is showing the trends, which is important. If you've attended any of our previous webinars, we always like to touch on trends because it tells a story.
All right. So this business decided to purchase that new, let's call it a skid steer, that new skid steer in Q1 here. And now they want to monitor how efficient or effective is this skid steer within my business, and was this a good decision, or was it a bad one? So here we have on the left hand side, we have asset turnover. So if you remember, this is total sales over total assets. So how effectively are your assets able to generate sales for you? And so here, Q1, we started at 2.8. Q2, they had quite a jump here at 3, which is great. Increasing is great. Q3, they're at 3.1, and Q4, they kind of level off there at 3.1. So far, it's looking like they made a good decision, right? And now return on assets, which is Joe's favorite. It's how effectively your assets are generating net profit for your business. And again, this is great for holding your employees accountable to the net profit, right? So here, Q1, that's when they purchased that skid steer. They're at 8%, all right? Q2, they increased by 1% to 9. Q3, they had a jump to 12%, and Q4 kind of decreased again to 10%. But overall, they increased, from Q1 8% all the way to Q4 10%. So that means they were more efficient within their business overall by purchasing that skid steer. And so that's why monitoring trends are important, right? So that way it gives you confidence for your next business decision, and you can establish certain ranges in your business as well. So if you're ever out of a range, then you can identify it and drill in to figure out what the problem was within the business. And of course, looking at trends in these ratios, it becomes easier the more financial data you accumulate. So, if you're someone that has been in business, 10, 20 years, and you have all of that data, then it becomes easier to interpret. But even if you're just starting out and you're in your second or third year, then, even calculating those ratios are great. Trends are important because they help you identify areas within your business that are on track and areas that need improvement. And again, you saw how these ratios helped this business make an important decision, right? And ultimately, it was for the better.
Great. And, looking at working capital, right? And working capital, is what your business has, right, to really run the day-to-day operations, and it's defined as current assets minus the current liabilities. Our previous webinar, we touched on this, and we went in depth into it. And basically, you want to look at your current assets, and you can see them in green. And then even, if you exclude cash from that, then you can really see, right, what are those items, that are, really influenced by your current liabilities. Whether you have a lot of cash or you don't, you want to see, really the performance of the business. And then even comparing that percentage, right, so that net working capital of 7% over there on the bottom left, to your net income in your profit and loss, right? And if you're, you want to make sure that you have enough net income to, really handle some of those ebbs and flows of the current liabilities, and the working capital. So this is a good barometer to look at, when you see companies that are growing fast, or companies that are making a decent net profit, but they're running into cash flow problems, or they're looking at their bank balance every month and it's not improving. Why is that? Because you're looking at your profit and loss and you're seeing high profits. Working capital has an enormous effect on that. So that's really the main takeaway here.
Great. So we said looking at your balance sheet and measuring it against industry averages is a great indicator. but so is measuring it against the historical information, right? So here we have an example of that. So on the left-hand side, we have the balance sheet as of March 31st, 2021. And right next to it, we have it as of 2022. Okay. So the balance sheet, when you calculate these certain ratios, so for 2021, the current ratio was 1.4. So the current ratio is current assets over current liabilities. This is how well the business is able to pay for your short-term debt. So your upcoming payroll, sales tax, your trade credit with Site One. How are you able to pay that? Are you able to pay that, and how efficiently are you able to pay that?
Yeah,
Anything
and Carla,
over,
excuse me, I just want to
yeah,
make sure that everyone understands this layout as well. So, um, as everyone remembers, right, earlier in the presentation, the balance sheet is as of a specific point in time, right? So, the first one towards the left, that was as of March 31st, 2021.
right,
Whereas now we're comparing that
right,
to the balance sheet as of March 31st, 2022, this year, right? And then above each one is the profit and loss. Some of the other data, right, that we get from the profit and loss for
right,
each one of those years from
right,
that period of time, those the trailing 12 months, right? Because the profit and loss is for a period. So it's for those 12 months compared to the balance sheet for that specific year. Using that data now towards the right side of the page, comparing the ratios from 2021 to 2022.
yeah.
I'm sorry, Carla, go ahead.
No, thank you. So anything over one in the current ratio means that you have reliable and predictable cash flow. So you're doing well in, but if you have anything under one, once you measure this, it would be a good idea to have some recurring or build up some recurring uh, sales, such as maintenance or something like that, because that can help with your cash flow. And so here we have 2021, they had 1.4, but then in 2022, they have 1.5. So they increased their cash flow. So that's a good thing. Then we have the debt to equity. So that's total liabilities over total equity. And this measure is a good measure for bankers, lenders out there. They want to know that you have as much skin in the game as they would, because they don't want someone who doesn't have that much equity in the business, because if the business fails, then they're not going to get their money back, and so that's why they measure this. But so for 2021, this company had 0.88, and then it increased 0.89. So this means that the company had more liabilities. It went up than it did equity in the past year. So it got worse by 0.01. Asset newness, we went over this. How new are your assets? So the more that this ratio increases, the newer your assets are. So that's what that did. It increased by 0.01. So they have slightly newer assets. And again, we want to be under, in between, somewhere around 0.5 with that. So return on assets, which we spoke about, net profit over total assets. So how effectively can your assets generate a profit for you? The higher this ratio is, the better. That means you're improving, and that's the case for this business. They were at 0.36 in 2021, but then they increased to 0.42. So that's a good indicator. Return on equity is net profit over equity, is the return for the shareholders, right, for putting in their sweat equity, their cash investment, all of this stuff. So this is important. So in 2021, the business owner made a return on equity on 0.68, which is good. But then in 2022, they're at 0.79, which is even better. So
Yeah,
that's
and
great.
and that shows you exactly why running a small business, there are a lot of things that can go wrong in a small business, right? So you want to be rewarded for that risk,
Right.
and that's why, for in
Uh,
this example, 79% return on equity, which is not unusual to see, is something that as a business owner you should be shooting for, right? You should be shooting for getting a high return on your money,
right.
because there's more risk in landscape business than there is in real estate, or you know depending on what you do within the stock market or within real estate. But it's you know so you want to make sure that you're being rewarded,
Yep.
and if you're not, you want to at least know that your return isn't as good as you want, and that's why it's important to have this data so you can work towards something.
Right. Yeah, because if your return was 10%, why not put that into the stock market? Like you would get 10% back, right? So that's a good point, Joe. Um, Asset turnover, again, that's total sales over total assets. And so how effectively are your trucks, trailers able to generate some sales for the business? So the higher that this is, the worse that it is. So in 2021 it was 2.4. In 2022 it increased to 2.78. Debt ratio, we have total debt over total assets. Again, you don't want to have more debts than you have assets, right? That would be a bad thing. So if this decreases, then you're getting better. So that's exactly what this company did in 2022. They had 0.47, so they decreased in this range. So they know exactly what they need to work on.
Fantastic. And really the the main takeaway from this webinar tonight, is having this data, knowing this, right? Because the more that you know, and the more that you're educated on this, um, the less risk you'll encounter, because you'll know things that the average person won't, and that's really why we like seeing people here at these webinars. Is we want to make sure that you know that you guys are prepared for running your business, scaling it. We have a lot of clients that are doing tremendous things, going scaling their business very fast. um, and even if that's not your goal, just operating a business, um, and that's um, really one of the main takeaways that we want you guys to take. um, and looking at the balance sheet in particular, you know does your company have the resources it needs to expand? Not just looking at your income and expenses, right? Does it have those resources within within your balance sheet, as we went over? um, should you take steps to increase some of your cash reserves? Maybe thinking about having 2 months of operating expenses set aside. That's something you want to definitely consider, because times may be good now, and you may be experiencing cash flow, but now is the time to prepare for the slow time, which it may be for you, maybe towards the winter. So now's the time to plan. Now's the time to set some of that cash aside for those low times, for tax purposes. So and that
Awesome.
that wraps it up for today's webinar. So please ask some questions in the side as well. We still have a couple minutes here to go over some of the questions.
So Jean says, back when we were talking about retained earnings, they said it does not go to earnings, retained earnings, if you take it as income, right? So I'm assuming by income you meant like as a salary. If you take a salary, it then that doesn't go to retained earnings. And in that case, if you do take a salary from your business, then that would lower your profit because your salary is on your profit and loss statement as an expense. And so that would lower your net profit. And remember, we said net profit or loss gets closed out to retained earnings. And so that's how that would work. Jean, let me know if that answered your question. Is accrual accounting better for lenders / investors? I would say accrual accounting, it is better for investors just because it's based off of actual production and not just what hit the bank, if that makes sense. Someone said, what was average ratio for industry again? Industry benchmarks, return on assets. So the return on assets was net profit over total assets, and the industry average is around 21%. Again, like Joe said, we want to be above that. So, but that's where it's roughly around on return on assets. And I like how you were all helping each other out in the chat section with asking some questions there while we were talking.
Yeah, and I'm going to send this recording to everyone that registered as well. So you'll all get this in your emails, probably tomorrow morning.
It said, someone said, how does depreciation change if making loan payments on an asset on a Schedule C versus an LLC? So it doesn't differ if based on your entity type. So depreciation, it doesn't differ if you're an S corp, a sole proprietor. As depreciation, tax depreciation is the same across the board. And if you're making loan payments towards that asset, it doesn't make a difference because initially, if whether you have a loan tied to that asset or not, then if you had a loan tied to the asset, then both the asset and the loan get posted on your balance sheet. And so the loan would be in your liability section and the assets would be in your asset section. And then the way that you depreciate that stays the same. Some good questions here. And I would like to thank everybody for joining us and staying with us through the balance sheet. Again, I know it's not everybody's favorite, but it is important. So no, I'm glad there were some good questions I had here. Awesome.
Yeah. Have a great night, everyone.
Yeah. Good night. Thank you.